More pain for stocks is coming. I'm your host, Steve Van Metre, and thanks for joining me today. And Michael Burry is warning investors that they're going to get burned as it will take more bankruptcies and defaults before stocks bottom. Let's over to Bloomberg, where he picked today's story up. As Burry re-ups on gloomy prediction, we have not hit bottom yet. And there's more pain to come for the stock market, according to Michael Burry, who says we haven't hit bottom yet. No, we haven't. He says watch for failures, then look for a bottom. Two SPACs ETFs failing is not near enough, he says. And Burry referenced the recent closing of two exchange-traded funds that track special purpose acquisition companies, one of the investing fads that drew in legions of retail traders in the pandemic bull market. The two funds traded for less than 2 years before losing investors as their share price plummeted. And this is important. What he's suggesting here is if you go back to the dot-com bubble or the great financial crisis, do you remember that lots of companies failed? There were lots of defaults. There were lots of delinquencies. Lots of things happened. It wasn't just two companies failing or just two things here or there. It was a large number. So what he's trying to tell you is, look, if you think this is the bottom, we're nowhere close. The worst is yet to come. In another tweet on Wednesday, he notes crashes in cryptocurrencies, meme stocks, and SPACs, and seemingly linked market crashes to 2000, 2008 to what he sees coming this year. And here is that tweet: crypto crash, meme crash, SPAC crash, inflation, 2000, 2008, 2022, check. The legendary hedge fund manager says. And what he might be suggesting here on this chart is we're going to take a look at the personal savings rate against the 4-week moving average of initial claims, because one of the things that happens, going into a recession, as we talked about on yesterday's show, is there is a dollar shortage and there just isn't enough money to keep propping up all of these speculative asset classes or investments, and next thing you know, the floor falls out. Let's take a look at this chart. What we see here in blue is a personal savings rate, or what the government perceives as the money you have left over after your paycheck to invest. Now, they don't say that you do invest it. What they suggest is that you could invest it. And so notably going into recessions where we see this gray bar, we'll note that the personal savings rates tend to get to a fairly low level. And the reason that happens is because inflation starts to eat into what people can afford to invest. And then next thing you know, you'll say, well, wait a second, but the savings rate starts to increase during a recession. How does that be? Maybe that suggests that money's flowing into the markets. No, it's just the opposite, because what happens in red, you'll see the 4-week moving average of initial claims. What we're note here is that as people lose their jobs, what do they start doing? They start saving, not investing. And so what happens then is, of course, the recession takes hold, people start saving, those assets start to break, and next thing you know, the economy goes down with it. And warnings from Burry about coming turmoil have become common on Twitter this year, with the founder of Sign Asset Management predicting consumer spending and stilliness in the markets will cause trouble for investors. In the second quarter, his firm dumped all of its equity exposure besides one company. Well, perhaps Burry should have just gotten Portfolio Shield. I'll put a link up here in the corner and in the description below. Because what he's suggesting here is that the junk loan defaults are worrying Wall Street investors. And this is, again, what you start to see when the money starts to dry up. As defaults on so-called leveraged loans hit $6 billion in August, the highest monthly total since October 2020, when pandemic shutdowns hobbled the U.S. economy, according to Fitch Ratings. This figure represents a fraction of the sprawling loan market, which has doubled over the past decade to about $1.5 trillion, but more defaults are coming. And that's exactly kind of the point. When you see a dollar shortage, what happens? There isn't enough money to pay on all these loans, and then eventually what happens? Well, you end up delinquency and default, and the economy blows up. And here's a good example of why that happens. We note the money supply, or which is referred to as the M2, and I've overlaid that on year-over-year rate of change against the federal funds rate in red. And so kind of what happens going into recessions, we tend to see a slowdown in money supply growth. Now, not always, but we tend to. And then you'll notice as the Fed starts to hike and the money supply starts to increase. Now, there's two ways the money supply can grow, because it's just the money, and think of it as in your checking and savings account. So how is money created? Well, we look back and say, well, it's created when money is borrowed into the economy and it creates a new checkable deposit. There's another way it grows is people start saving more and spending less. Now, one of those leads to inflation and economic growth. The other is bad news and leads to things blowing up, and you can guess which one is which. So what we see going into the recession now is the money supply starts to grow. People stop putting money into the markets and investments and speculative things, and next thing you know, things start to go wrong. The other factor here is you start to look at it from the loans and leases. So you start to say, where is this dollar shortage coming from? And we note that loans and leases and bank credit shown now in blue against the M2. You see a slowdown in new money creation by the banks. Now, right now, we're seeing a surge as, of course, banks were hammered by quantitative easing and are eager to lend, but for how long before that rolls over and heads lower? Notably, that starts to happen prior or right in the middle of recessions. Borrowers are particularly vulnerable to the double whammy of weaker earnings and rising interest rates, according to a Morgan Stanley strategist, that will trigger a wave of credit rating downgrades and push average loan prices, currently 95 cents on the dollar, below 85 cents, a level breached only during the 2008 financial crisis. So we have two factors now. Not only do we have a shortage of dollars, but we have higher interest costs. So all these companies and all these investment vehicles that need cheap money to keep running, well, now they're forced to borrow at higher rates, and that leads to bad things. Falling loan ratings and prices will make it harder for companies to borrow to fund growth or to repay their existing debts. And that is a major problem because tighter financing also drags on growth, increasing the risk the U.S. economy will fall into a hard landing. And data from a recent Fed survey of loan officers at top banks showed that tightened lending standards and that a Barclays model predicted that could cause roughly 4.5% of loans in default a year from now. Now the question is, what causes banks to tighten lending standards, you ask? Well, for that, we got to look at the bond market and the yield curve. So here we have the 10-2s, or 10-year Treasury minus 2-year Treasuries in yields. And what I want you to understand, showing this in red, is when it goes below this gray line here and inverts, you'll notice that bank lending standards tighten. They go above the black line. And that is telling us that banks don't want to lend that much. Now, why does that happen? Well, it's simple, because banks borrow at short-term rates and lend at long-term rates, and when those two are inverted, well, they're not really profitable. So as you can see, again, coming back to this chart, lending standards are tightening as the curve inverted is suggesting things are only going to get even worse. But from the Fed's perspective, we see in yesterday, a Fed report shows weak U.S. growth outlook with inflation cooling. And price levels remain highly elevated, but 9 districts reported to some degree of moderation in their rate of increase. The price of food, rent, utilities, and hospitality services in particular rose substantially across all 12 districts. So what is that telling us is likely to happen by the end of the month? The Fed is going to probably raise rates and raise rates substantially. And how does that factor here? Well, when the Fed raises rates up, what do? They pull back on demand. That's what they're trying to do. And how do they accomplish that? By getting people to borrow less. You get less money creation, and of course all that does is make the dollar shortage worse. And looking at what making things worse, we head over to the ECB with this headline from the Wall Street Journal as they raised interest rates by a historic 0.75% as Europe stares straight in the face of a recession, as rising borrowing costs will likely increase the risk of a slide into a recession for Europe's currency union, which is wrestling with surging energy costs and sagging confidence among households and businesses driven by the war with Ukraine. And with governments piling on debt to shield consumers and businesses from the impact of rising prices, a national election in Italy later this month could exacerbate strains in the region's bond market, but yet the ECB's move should help support the euro currency, which recently sank to a 20-year low against the dollar. Of course, as we talked about yesterday, good luck with that. We'll see how that plays out. I don't think it will, because what is the Fed going to do? If you believe that central banks control their currency, well, we know the Fed's likely to do at least 50, but more likely 75 basis point hikes, particularly when in fact we look at the unemployment claims, which you just got today. And what do we note? That employment claims, initial claims fell 6,000 to 222,000, now beginning to downtrend lower, putting the Fed strongly in play. But notably, continuing state claims were up 36,000 to 1.437 million. And what is that telling you? Well, it means people aren't losing their jobs as much, but what it suggests is those who have lost their jobs are struggling to find them. We went through a wave where employers got rid of people, and now they're kind of in a lull, seeing if the economy turns around. But one thing that doesn't look so good is the oil and gas industry, and for that we head over to Tracy's shoe charts, recent daily, weekly, which will show up in your email box tomorrow. And here we can see that European Union energy disaster continues, she writes, as the West's biggest economies on Friday agreed to impose a price cap on Russian oil in an attempt to reduce Moscow's ability to fund its war in Ukraine without further stoking global inflation. Well, what does Tracy think about that? Well, she talked about this back in June, that price caps would not work, suggesting that it is not enforceable as other countries do not have sanctions, and Russia announced it will simply just not sell to countries that enact price caps. Now, if you want to read more about what Tracy has to say, you can still sign up for a limited time now. Markets Insider Pro is in the description below. You'll get her report in your email box tomorrow, along with Jeff Snyder's and mine. And with that, now you can see why Michael Burry is saying the bottom's not here yet. We've got a long way to go, a lot of defaults, bankruptcies, and failures before we get there. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.